Ladies and gentlemen, welcome to the fifth episode of the Art of Manager Fusion here on EBNet, brought to you by Alexforbes Investments. For the first four episodes, we've been talking about some of the skill required in order to assess, to blend, and select your asset managers for your investment strategy. We're going to take a bit of a departure today and talk about something that I feel is too often ignored, which is the assessment of the administrative capability and setup or the infrastructure of asset managers, which in its own right can produce risk for investors. So I'm joined by the head of operational due diligence at Alexforbes Investments, Julie Govender. Julie, welcome and thanks for joining us.
Thank you so much, Leon, and thank you for having me.
So, ever since I was in the multi-management field, we made a lot of noise around the fact that we would go kick the tires of the asset managers, not just to understand their philosophy and their people, but to dig in around their back office, their structures, their compliance, their pricing, their administrative systems, to ensure that they had the right processes in place, that they wouldn't make errors. Right. I think a lot of people thought, why on earth are you doing this? Why is it so necessary? And we made noise because we picked up errors. Sometimes we would put through a transaction. The transaction was loaded as a withdrawal rather than a contribution, or vice versa. Or sometimes we put through a transaction, and this is going back and showing my age, we would send through a fax. And that fax would sit in somebody's intro, and the cash would not be allocated to the customer's account and would not earn market returns. And the reality is that's an error by the asset manager, not the client's fault. And we would then fight for the client to ensure that they were put back in the correct position. So I believe operational due diligence, just that level of simplicity on a traditional asset manager, is absolutely critical. It's a key part of what any multi-manager ultimately does. And now, as the world starts looking at private markets, it's even more of an issue because there's more risk that ultimately rests on that side if not managed appropriately. So I just did your job for you.
You certainly have. You've commercialized what I've done.
Good. So, do you agree? I'm assuming you do, and fill in the gaps there. What else is important when it comes to, let's maybe separate private markets, we can come to that a little bit later, but just focus generally selecting asset managers. What are the kinds of checks and balances that need to be done, and why is it so important?
No, absolutely, Leon. The whole idea behind the operational due diligence is to understand what happens beneath the performance numbers and understand what the manager's operating environment is like. And do they have the appropriate systems, people, processes, mechanisms, controls, etc., in place to take care of that investment and to ensure that those returns are very well supported, and also to prevent losses. So there's a number of components that go into it, which we will delve into as we go about the discussion today, Leon.
Okay, so do you find, let's get to the core of it, do you find that asset managers make errors?
Most definitely. Leon, errors is something that cannot be prevented. It's about an organization understanding what are the type of errors that they will be exposed to, and how do they prepare to mitigate for those errors. Okay. No organization is perfect, and those errors will come through, but how do you manage it? Do you have processes in place to manage and identify and even prevent those errors from happening?
So I've learned over time, and I agree with you fully, no one's perfect, errors will happen, all right? But the key thing is you need to pick up on errors as quickly as possible to prevent them from getting out of hand, if I could put that way, becoming too material. But also you can identify where errors may happen through your due diligence. So let's start there, if you don't mind. If I come along and I say, I like Crailing Enterprises investment manager, and well, your investment team says that, and you need to now do a due diligence. What should I expect? What are you going to come and check? What tires are you going to be kicking?
All right, now absolutely. So we would look at the entire operating model for that supports the investment process, Leon. And it firstly begins with the governance and the ownership of the organization. Here we want to understand how your board is made up. Is there independence? What is the culture of the board? Is it effective? Do you have the opportunity to ask challenging questions? Do you feel comfortable to disagree with a point? So that structure for me is very important. Then we also want to look at, is there effective oversight? Is there clear accountability? Do you have appropriate committee structures in place that can challenge decisions and at the same time also provide support to the decisions that are being made? We further look and we assess the experience and the depth of the team. That's not just focusing on the investments, but also on the operation side. We would look at things like, is there key person dependency? Or what is your succession planning like? We look at further, are people adequately qualified for the roles? Do you verify their qualifications? We also look at areas such as segregation of duties. Is one person being responsible for too many areas? How does that look in the organization? What is the support structure looks like? We further go on and also examine the financial strength of the business. We look at what are some of the audit outcomes. Is the organization's financials being assessed as a going concern? We further go into the regulation and compliance arrangement, understanding, simple things. Do they have the appropriate licensing? Do they meet the requirements for phase? Do they have the appropriate policies to support the business and its outcomes? We further go on to look at things like, do you have insurance cover? What insurance cover do you have? Understanding how investment decisions are made, how the trade processing process is, who's responsible for it, and is there a set of duties when it comes to that? Going on to the administration side, we look at how recons are processed, be it cash or script recons. We look at cash controls and how that is being monitored and approved. We look at fund administration, fund valuation, and also very important is the risk management component of that organization. We also look at technology, and we find it to be a really important area of the business. We consider IT governance, cybersecurity, and we look at areas such as access control, system changes, and who's responsible for that. We look at data protection. Do you have incident management controls in place? And key as well is business continuity and disaster recovery and the dependence on technology providers. We also look at the selection and oversight of administrators or custodians that might be in place that have been appointed by the provider. But the principle that we look at is not only do you have policies and frameworks that support your business, do they exist? We want to understand that it is applicable to the business and it works in practice and that there are all of these controls in place.
So music to my ears. It's fantastic to hear that someone is doing that because it's so, so important that all of those foundations are in place. Because if they're not, errors can occur. But also if they're not, it's likely that the investment professionals can't carry out their jobs with the necessary focus that they should ultimately have. And I told you I was going to put you on the spotlight, so here we go. First question will be, not all organizations are equal, right? And we're in a country where we do need to see SMEs develop and create jobs and so on, but it's difficult when you're smaller to afford all the fancy infrastructure that perhaps you need. So how do you calibrate from a proportionality perspective when looking at asset managers, or can you not? Is it simply a case of there is one standard and that has to be applied?
All right. So Leon, we do have a framework that's been developed that helps support what we do. And I look at operational due diligence as being a gray area. And the reason why I'm saying gray is because I cannot compare a large asset management firm to a smaller asset management firm that is up and coming. So we will look at it comparatively, and we will look at what is most applicable for that organization. And we will also then consider how that organization can improve over time. Where it's a larger institution, their expectation is for the governance and controls, etc., to be in place, largely because they have a far bigger book that they manage, which means that there is enough capital to support everything that they require. With the smaller organizations, we would still look at each of these factors. However, we are a little bit more generous in terms of how we rate them based on the size. But we continue to work with them to ensure that they develop and they enhance and get them to start thinking bigger. So move away from thinking, I am a small asset manager, so I don't require all of these controls. We look at it from a responsibility that they have to the investors to make sure that they do have control. So yes, some of the controls, Leon, are absolutely non-negotiable. An example that I want to use is if we're looking at governance and independence on the board. If it's a smaller asset manager that's less than 5 years old and is still building capital, it's acceptable for them to have one independent non-executive director sitting on the board. But if you're an established organization, we want to see 2 or 3 of those. Again, what we do find, Leon, with the smaller asset management firms is that they outsource most of their functions, and they focused on the investment component, which is what they're really good at, I suppose. And with that outsourcing, you find that they make sure we ensure that they do have the relevant oversight in place to manage those outsourced requirements. It becomes a challenge, however, if they are small and they want to do administration in-house, for example, then that is a massive red flag, and we're not very comfortable with that. But if it's outsourced to an administrator, comfortable, and then we'll just manage and we'll just manage and have a look at what that oversight responsibility looks like.
So at the BITSETA conference, there was a talk on stage where it was around established versus emerging asset managers. And one of the questions, I think it came from the audience, was around the operational risks that you would end up running. And it was quite clear that there is I don't know, misunderstanding is the right word, or a bias to assume that because you're small, you are higher risk, which is not necessarily the case when it comes to asset management. Why? Because of the outsourcing model. So a lot of these smaller asset managers will outsource compliance and get the necessary services at a variable cost, or they would outsource their administration and pay according to the assets that they ultimately have, and so on. And those administration houses in their own right would also probably administer for bigger organizations. So you're getting the same in the way of a risk profile, if I could put it that way. You could even argue that the bigger asset managers that bring it in-house might even pose greater risk because they don't have the scale of the professional guys. But admin is a dirty job. It's a low margin, highly intensive environment. And because of that, these professional outsource administrators have had to build significant bulk in order to be sustainable. Others have tended to then underinvest in their business in that right, creating risk. So South Africa went through a stage, if I remember correctly, where everyone was just outsourcing. Get the money out there, put it with these professional administrators. Then all of a sudden, not everything was working out. So now bring it all in-house. Let's in-source everything again. Where is the market in that regard, and how do you see these standalone administrators versus guys then in-house?
Yeah. Really good point that you've raised, Leon. Going back to outsourcing and more specifically outsourcing fund administration, you're right, the standalone houses work really well. Why? They have the people, they have the systems, they have the controls, etc., in place, and the same level of service that is being provided to a larger institution is being provided to the emerging asset manager. So that comes through. Outsourcing, going to your point about, outsourcing went out and then it came back in and in-house. So when you outsource a function, it does not mean that you outsource the accountability. And that is something that has to be very clear when a function is outsourced. The accountability still sits with the organization. It is their responsibility to understand and manage risks from the outsourced activity. What you'll find with some organizations, once the outsourcing is done or the contract is signed, there'll be minimal interaction with the provider. But what we are seeing more and more, and this is coming through quite clearly since Joint Standard 1 of 2024 was introduced, which talks about the minimum expectations for the outsourcing of material functions. The standard is specific to licensed insurers. However, the principle around it should apply to everybody. And we see that coming across so clearly. So what the standard talks to, Leon, it's the need for a structured outsourcing framework. So it's necessary. How do you go about your outsourcing? The process of putting your tender out, discussing the responses that you receive from the tender, and how you choose the most appropriate provider for your organization. Again, it goes back to talking about what are the governance that you have in place, the risk assessments, and for the asset manager to go about and do its own due diligence before appointing the manager. So we're finding that standard provides an excellent framework for outsourcing. What we do see, however, like you've mentioned, with the larger institutions, they bring that in-house. What it means for them is that they've got to ensure that they have the sufficient headcount in for this type of work. So they've got to make sure that they've got proper checks and controls in place. They've got to make sure that they are being able to monitor this, and they have the systems. Very, very key on is the systems to support. We want to see managers that want to do their own admin move away from manual transactions where there is a reliance on an individual or two individuals. We want everything to be established on a system with processes, with audit trails where you can see the history, etc., coming through. So again, Leon, it's about being responsible and having the accountability of the function that is being outsourced. You look at things like developing service level agreements, understanding if there are incidents, how would that be mitigated or how would that be corrected? How would breaches be reported? And furthermore, going into outsourcing, Leon, there's also the very key element of data protection. Who has access to what data. You also want to understand with your provider what their business continuity arrangements are like. If they are doing business continuity or DR testing, are you as a client included as part of the testing? And if as a provider they are subcontracting, are they making you aware of the subcontracting agreement? Do you have sight of it? Do you have input into it? And also then another risk to look at as well, Leon, is if you are looking at one of these providers, you could see concentration risk come about, but the concentration risk can very easily be mitigated by the larger teams that these administrators would appoint. So they have sufficient heads, and then they have more automated process. So there's not reliance again just on people. And I want to say this, looking at a provider and thinking that they're credible and, they have a long-standing relationship is not enough to have effective oversight. But you've got to make sure that you've got your SLAs and your KPIs and you have ways of monitoring how they are being managed.
But I'm going to give you a bit of food for thought that you can reflect on and give your opinion on, because it's an interesting concept. So all of what we've spoken about are fantastic hygiene factors, and every investor should be taking that into account. And I want to come back to the conversation later because I'm not convinced people are and are applying themselves properly. But anyway, you sound wonderful, okay, until one thing goes wrong. And
Correct.
all of a sudden, well, where was your due diligence? Yeah, well, we did it, but we didn't see. So I'm going to use a couple of examples because it's not as easy as just going knocking on the door, okay, it's solid. Okay. It's you sort of knocking and well, what's going on there? It looks like a door, but what's happening behind it? So some of the biggest organizations in the country, and it's appropriate to name them because they did have to pay fines, which was 91 Sanlam, I think it was, and Discovery for their failure to follow FICA processes. All right, a very important control that these entities should ultimately have. Now, if you went to due diligence them, they're not about to say, no, we don't follow our process. Okay. And it's very difficult to check whether they indeed are following their process until something goes perhaps wrong or the regulator manages to pick up on it. So there's one example in terms of it. The same applies to business continuity. I always smile when I think of business continuity because I've been in the market for 30 plus years. Julia, I've only done 2 actual business continuity exercises over. I'm not going to say where or how it was, but I can tell you that it was a lot of fun as we made out that the building was on fire. The one day we stood in the street for 15 minutes and ended up at a pub for the rest of the afternoon. So I'm not convinced, and I'm throwing the blanket out at everyone. Okay, perhaps only the minds are good when it really comes down to those kind of controls and processes. Why? Because it's so serious for them in terms of deaths and so on. But I'm not convinced that if anyone says, yes, everyone's got a business continuity plan, they need one for their business model. Okay. But do they live it? I mean, if something goes really wrong, everyone's thinking, I actually want to use this story. I took my daughter to London the other day, and at 3 a.m. in the morning, the fire alarm went off in the hotel. Okay. I lay there thinking, oh, I don't feel like getting up. Okay. It was only the parent in me that said, look, my daughter's in the other room, so I really do need to, get up. And also there was this red light that was going on in the room, so there's no ways I could get back to sleep. So anyway, I got out of bed and I pulled the gowns out the cupboard and I went to my daughter and I said to her, Bailey, come, you must get up. We must go downstairs. There's a fire alarm. At which point she said to me, leave me to burn.
Typical teenager, I guess.
So it shows you the mentality we have when it comes to these things, because it's not real until it happens. Luckily, the building, the hotel was not on fire, so we got to go back to bed. But it's quite difficult to test whether those things truly do happen, whether people truly do live it. And it's not like someone's going to ever say to you, no, we don't do that. So how do you cater for that? Because that's your risk at the end of the day. Because now you say you're doing these things, which is great, but then you get into trouble when it doesn't actually come to the fore.
Yeah, no, absolutely. So as much as you're checking if there are processes, we're also very evidence-based. So describe the process, show us on your systems how it works. And going back to the business continuity case, it's compulsory for testing to take place annually, not just physically, but also logically, and to ensure that systems, etc., are up and running. So when it comes to your business continuity and DR framework or policy or guideline, what we typically look for, Leon, is, are all the potential events listed? If there are contact people, are staff made aware? Who do they make contact with? Where do they work from? What are the steps that they need to proceed? To proceed if they are physically in a building. So all of that is tested by the type of questions we ask and asking for the evidence of the test results that they've conducted. So they can say, yeah, we actually did a test in July 2025, and we're preparing for the next one. Please show us the test results. What did you identify? So the need for evidence is a requirement. We don't just hear what they have to say, because then it's only a representation of what they say. We want to see the evidence and be comfortable with that, Leon.
But I think also it's important that the audience understands that you have certain lines of defense. No line of defense is impenetrable, but it does hopefully provide some protection and lower the probability of there being a problem. And there's no doubt that the checks and balances that you do um, will provide some form of defense, but it's never impenetrable. That's the reality. And another
That
example is
is
a lot of these administrators or asset managers will rely on third parties for their systems or whatever that might be. And we talk about cybersecurity. We had a case the other day where the party was hacked through a third party, ultimately system that they've got. So when it comes to cybersecurity, we have joined standard two. It's a bit of a hobby of mine, if I could put it that way. It's probably more than a hobby. But we have a business that's helping people assess their providers based on the various international standards and objectively score and rate. I can show you on the entire asset management community the scores from a cybersecurity perspective. Surely you guys should be doing that or getting your hands on that information as part of your due diligence as well.
correct. We do. So we don't just look at what are the cyber security controls that they have in place for themselves, but also in place for their third-party providers. Looking at all the different third parties that they would use. That it's not just about having robust, systems and processes, etc., and what those hygiene practices are, but it's a systematic testing of the controls. It's the vulnerability testing. It's the cyber resilience capability. So very key, Leon, is the cyber resilience capability that you get software that you can install to prevent hackers from getting into your systems, etc. But more so, Leon, what we are looking at is, do you have a governing body to manage this? Is there a cybersecurity strategy for and a team of people that monitor this, looking at how confidentiality is protected, the integrity and the information of your systems are being protected again. And if you were happen to, to be hacked, how do you then recover from that? At what point will it get stopped? So the continuous vulnerability testing and the pen testing is absolutely key. So there are systems that are installed that can do daily, when I say daily, it's like consistent throughout the day testing for any vulnerabilities. And we find that it works as a good preventative tool. And if asset managers don't have that, we tell them, please speak to your IT provider to get this program installed. But Leon, what we're also saying is don't get your IT provider to do the tests because you can't do your own homework and check it. You need to outsource it to a different provider to do the vulnerability checks and the pen tests, etc. Because they are now going to check your provider's work, and if they identify any loopholes, etc., how can that be contained? How can that be rectified? How can that be restored?
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
I mean, the same thing applies ultimately. If I was a trustee and you came in and you pitched to me, and I would be quite comfortable with the due diligence processes you followed and your track record and all the rest. But I would want to know that before you move from manager XYZ to manager A, B, and C, that you've done those checks on my behalf.
Yeah.
And I would ask you to show me, just like you said, you look for evidence. Right. As a trustee, you should also look for evidence because it's one of the biggest risks we face in this day and age to see, well, show me how good this is and that is, and so on, before you move money and then go find out afterwards that perhaps they aren't that good. And the same thing would apply in terms of independence. where are you marking your own homework, and where are the lines in that respect? And as a multi-manager, an asset manager is a third-party provider, effectively you contracting with that provider. So it's your responsibility in that respect to do those checks, where in the case of the trustees, the checks on you shouldn't be reliant on your view. It should be reliant on another party that is independent of you to say, yes, they've done their checks, and yes, they have the following in place, and so on. So that's just all good governance. That's how you
Correct.
manage your risk ultimately. Um, there was another point just on the cyber side that I was thinking about that I wanted to ask you. Oh, yes. So as a multi-manager, you contract with a third party, so you have to do, according to joint standard, to your third party checks. Okay. The
Correct.
law says that, and good practice says that. Now let's come to the investment consultants. Right, an investment consultant, I always say, is on the one hand Darren, on the other hand Darren. So you can have this or you can have that. It's that whole kids thing, 6-7, 6-7, 6-7, whichever it is. Right. But even in that case, you're putting forward a view. Surely, when you put forward that view, you should have also done some kind of an operational due diligence, including cyber within that. You can't say cyber is not, we're investment professionals, we're not cyber professionals. It's a key component of everything that we're talking about. So you need to get the assessment done to say to Mr. Trustee, this is somebody I'm comfortable with. This is also somebody I'm comfortable with. This is somebody I'm not comfortable with. All right. So how do you guys apply all of the stuff that you do from an operational due diligence across, we've spoken multi-manager, it's obvious, but then across the consulting side, or is it an additional service that the customer would have to acquire?
All right. So I'm going to look at it in the Alexforbes terms. So if it's a consultant bringing on a client that is going on to our book of business, as part of our responsibility, we would go ahead and conduct the full due diligence on their underlying asset managers that they choose. However, if our consultants are only providing an advisory service to them and recommending managers, then it's up to the client or the trustees to engage us to conduct a due diligence, which we have in some cases.
So you would also effectively do a due diligence for individual clients where they're looking at a particular setup of managers to give them a reported view on the risk associated.
That's correct, Leon.
And to me, I mean, I'll put it out there, and I'm not trying to talk to your book, I get nothing for it. But the reality is that every trustee board should do that. There's not a single trustee board that should move any manager without doing an operational due diligence.
Now, you're absolutely correct. It's not a nice to have. It's imperative as a responsibility to your clients to make sure that your underlying asset managers meet best requirements and have your client's best interest at heart as well.
Okay. So another line of defense, so you've got your, call it preemptive stuff, prevention rather than cure, but then you've got your cure. So you guys run back office, does admin, provides unit prices, facilitates cash flow from a multi-manager perspective. And one of the benefits I've always believed of a multi-manager is that same team or an element of that team will do checks, post-fact checks. Was this allocated correctly? Did this get accounted for? Was the valuation done correctly? And so on. So are you able to just give a little bit of a flavor on that? And then I want to talk about where that's missing on the consulting side.
Yes, most certainly, Leon. So yes, everything again is, if I'm looking at it from an Alexforbes context and how we all outsource. So yes, very much so. Everything is system driven. There's automation. When it comes to pricing and evaluation, we look at multiple pricing providers to see the consistency of the amounts coming through. Again, we look at a three-way reconciliation. We look at reconciliation between the broker, the custodian, and the administrator to see that those numbers tie in. So every step of the way, there's constant checks that takes place. Now, it's not just applicable to Alexforbes. It's a general application that we see coming across asset managers with the three-way recon checks to ensure that pricing, etc., evaluation, etc., especially for the listed funds, it comes through. It obviously differs when it comes to your private markets space. So those checks absolutely important to be in place, and then to have the oversight confirming that those checks have actually been done.
So, I mean, I remember back in the day where we picked up errors, 5 million rand, one shot of money not being properly invested for a period of a week, and that was the market impact in terms of it. Now, the individual impact per client might have been, I don't know, 0.01%, but it was their money, and they deserve to have the manager hold account in that regard. So, I mean, like, when you're managing lots of money, when you're a big pension fund, small errors can still be very costly. And that's why I believe that all of these checks and balances as another line of defense is so important. But when you're in the investment consulting space and your client is not utilizing any kind of platform or unitizing or whatever, and just has mandates in place with asset managers, often those checks aren't happening, and money can flow and money can sit in a bank account rather than in the market. So I suppose that is what it is, but the reality is those customers could also in-source those checks if need be, by utilizing a platform that a multi-manager would use.
Definitely so, Leon. Definitely so.
Okay. Now, private markets you mentioned. What's different now in the private market space? As soon as I got involved in private markets back in 2020 or 2019, first thing the guy said to me, we need to choose an operational due diligence provider. And these are professional companies all around Europe, the UK, whatever, that specialize in doing nothing but due diligence on private market asset managers. And I was amazed, couldn't believe it. Right? But that is the truth of it. I still get newsletters that these guys send out daily from their businesses. It's become that professional. So maybe can you unpack that a little bit for me?
Yes, definitely. So the private market space it's really so different to the to the listed space, and purely because of the type of investment. It's very illiquid. Your valuation will differ based on how that specific investee company grows. But what's very key there, Leon, is with the private market space, you have your IPF guidelines for valuation. You have to not just value the investee company or the asset that you're looking at by yourselves within the organization, because you can obviously go ahead and inflate the value of that investee company. And this is where your independence again comes in. You get your independent valuators sitting in your valuation committee. Like I said, the IPF guideline is there. You get your independents come in, you get your auditors that still come in and check that the valuation is done correctly, at least on a quarterly basis. These investee companies or funds are valued. So again, the structure of the fund, independence that comes through, etc., is absolutely important, and checking that against what the market has as well, Leon.
Okay, so I get that. What is the skill set difference? Would you have different people doing different due diligences depending on the nature of the asset manager? Is there a completely different skill set? I'm trying to unpack that.
Yes, from a due diligence standpoint, the skill set in terms of the thinking slightly differs. So currently at Alexforbes, myself and my team, I'm going to use the word multi-skilled in this case. So we have actually developed a framework that guides us when assessing a private market fund and how we go about that. The thinking changes because you're not going to get daily pricing. Your liquidity is not as easy. So here a lot of focus is on, once you choose, so this is now post the fundraising, etc. Once you choose an organization or a strategy or an investee company that you want to invest in, why are you choosing them? How do you see the benefit from choosing this organization? What input do you have as the GP into this company, like sitting in their board committee meetings, being a part of their shareholder discussions, their board meetings, understanding how that business is run? All of that contributes to how the growth of that investee company would grow. And obviously that growth will impact the valuation of that business.
But it's also quite different in the sense that if you're investing in a listed company, you go through the JSE. Yeah, you're investing in a unlisted company, you're becoming a shareholder. You've got partnership agreements and that are this thick that can cost you an absolute fortune to vet. So do you go through things like that, look at these incommodante partnerships and give opinions in that regard? Because otherwise the barriers to entry are quite high.
Yes. So the risk generally is higher in a private market space as well. So together, coupled, the ODD team together with our legal team, who work very closely when it comes to this type of partnerships, looking at the risks associated with it. What I do find is that we generally come in at the tail end to go ahead as an allocator, having to see who else allocated before us, and that builds the confidence. However, having said that the risk is higher, we also see the benefits of contributing to the economy and the growth of it when it comes to the private market funds. So it's definitely worked on a lot closer, Leon, as we would a listed fund. It's the investment team. We have a specialized investment team that focuses purely on private markets, that goes in and does their assessment. And only once they're comfortable do they come to myself and my team and legal for us to look at the next steps. So it does take longer because we go through all of the information that's being provided, the contractual agreements, etc., before a proper informed decision is being made. And again, we sit with these managers unpacking every aspect of the investee company. For example, where are share certificates held, who signs on behalf of the share certificates. So, not just any individual in the organization can choose an investee company. So we look at all of the appropriate controls that they have in place in terms of choosing the most appropriate, including how they go about doing their research and presenting that before that investee company is shortlisted.
So people will tend to see ESG as being the ambit of the investment research professionals, but it's actually, in my mind, not. Perhaps some of the E and S questions will sit more there, but on your side, the G questions are important in terms of application of King 5, board compositions, compliance, all of those kind of things. So to me, is it fair to say that the G of the ES and G has to be a competency across your team?
Absolutely, Leon. It's actually a non-negotiable. The governance and applying the King 5 principles are absolutely key. In fact, when we find that those principles are not being applied appropriately, or only some of the principles are being applied, we flag it as a red flag, and we talk about it, and we will provide recommendations to the managers, to work on this and to improve. So it's a non-negotiable in ODD.
So if I'm an asset manager and I'm trying to break into this highly concentrated asset management industry, surely it's in my interest to actually come to you to say, come kick my tires and provide me with a report that I can utilize to show customers, to give them some comfort. So that sounds fine, but is it something that you would do?
Most definitely, Leon, and that is what we're actually punting as a business, at the moment, to tell asset managers, approach us, let us come and have a look at how your business runs and operates, and let us highlight any gaps or any risks, and let's provide to you applicable remediations that you can apply, but not just apply the remediations. How effective are the remediations that you've applied? Do you see the work in it? Is there evidence that it is being applied correctly? So it's certainly in their best interest to approach us. I mean, I have many success stories. I'm not going to name names at the moment, but I'll speak anonymously about them. Is where we see asset managers starting up, like you're saying, emerging. They probably might have just two portfolio managers decided, listen, we can do this on our own, so let's start this business. And all they focus on is on the investment return, and they never look at how the organization is going to operate. And then there's a lot of red flags that come through from there. But as long as they're willing to work with us, and I always say it's a partnership, work with us and let us help you to be better. Because once you are better, your allocations coming your way is going to definitely increase, and your business is obviously going to grow. So don't look at it as someone coming through with a stick knocking on your door, but look at it as someone coming through and saying, let us help you, and let us help you to be better.
I couldn't agree more. And bringing the conversation to somewhat of a close, I could actually carry on chatting on multiple things for a while. But I'm going to ask this question because I'm actually grappling with it myself and trying to understand a bit better, which is, call it the final line of defense or insurance, essentially. So I've been looking at the asset management community and their cyber insurance that they have in place. Some have nothing. I was like, whoa, didn't realize. Others have a couple of 100,000 all the way up to 100 million. Yeah, but then you look at that business and you say, well, the one's 3 trillion and the other one's only 2 billion. What is the ratio? What is a sufficient insurance sort of ratio or level? Because right now, all I can really say is, do you have or don't you have, and differentiate that way. I'm not certain whether 50 million is sufficient on 500 billion or whether 250 on 1 billion is better. I'm not sure.
Yeah. So Leon, I'm also unable to give you a ballpark figure. However, what I will say is it goes back to the size of the organization, how much they outsource. So it'll be based on their risk of the organization. So their insurer that they choose would be the most appropriate person to indicate what is the cover, what is the level of cover that they would require for the organization. It's definitely not something that they should not have. In fact, Leon, we flag it if they don't have cyber insurance cover, and we ask them to please go ahead and look at it. And then what you will typically find, it's hilarious, when you do emphasize that they do go and get cover, then it's just a 5 million rand cover. And always tell them, you're going for most likely the minimum amount of cover, but look at your systems, look at who your third-party providers are, because when it comes to any cyber attack, it does not necessarily have to come through directly from your organization. It can come through your key providers. It can come through any of the cloud platform that we use. So all of those risks need to be considered when you are talking to your broker, who then obviously will speak to the underwriter and determine the correct amount. So again, it's the risk profile of the business and what they are being exposed to. And the amount should be determined based on that.
Yeah, I want to have a chat to the underwriters, the short-term guys, and say, right, what is the benchmark? What is the model that should be applied so we can test ultimately to help customers also take a somewhat of a assurance from that. What I don't like is I have had a couple of customers saying to me, Leon, as long as there's cyber insurance in place, we're happy. I mean, like that's like saying, well, as long as I don't know, the SAP isn't too far away, we don't need an electric fence kind of thing.
No, absolutely, Leon. And it's never about the amount. It's about, is that value or the cover sufficient for your business type and for the size of your business? It's like if you look at the car that you drive. I mean, your insurance cover or is based on your risk profile as the driver, and then the type, the vehicle model, etc. In the same manner, that's how cyber security cover should also be considered. What is the size of the organization? What is the risk profile like? Are they using too many external programs? And again, what we're finding, Leon, is, and this is actually quite interesting, is that some insurance providers that provide cybersecurity cover are also telling their clients, are you training your staff in cybersecurity? How frequently is the training taking place? If you do not have this, we're going to recommend a provider to provide cybersecurity training, and it has to be done in these intervals. So they're also using it as a mechanism to also protect what they do.
Would you ever do independent penetration testing of asset managers I mean, they obviously all need to do it themselves, and it's a costly exercise. But I see some beauty in that somewhere in terms of keeping everyone. We spoke about the practical application. When you know that at some point in time someone else is going to look in, then you're probably more inclined to do that. Where I've picked up with a few guys, they say they do penetration testing, but they don't want to share the results because they say it's confidential. They don't want to put themselves at risk, which I understand, but it also means we don't need to show you because maybe we haven't done it.
It's very possible. But again, Leon, it is them confirming it, which you will document. That on this day, Leon Kralen confirmed that he has conducted penetration testing, and whatever remediations or whatever the results were, remediations were applied. So you hold them accountable for what they have told you if they don't want to share, and you document it.
Okay. Julie, thank you so much. I'm going to state the following, is that to me, asset management companies, the investment capabilities always tend to, I suppose, take the bit of the glory a bit more than others. They get referred to as the engine room, and let's face it, it is. I mean, that's what the customer is buying, but there are the hidden heroes and tribes within any asset management type of entity or multi-manager or whatever. And those other tribes, the jobs and the careers that are being created and professionalized over time are really exciting. And I think what you guys are doing, not only is there massive value, but there's a huge amount of intellectual development that is taking place in that regard. So congratulations, and please do keep the evolution of that going, because sometimes it might be seen as a cost rather than a value. I see it as one of the key values that a multi-manager brings to the table for investors. And I'll leave it at that, because I think that's the main point that I'd like everyone to take from today.
Thank you so much for that, Leon. And I'd just like to end up with, when you're looking at ODD, just remember that ODD looks beneath performance numbers, and it asks whether the manager has the operating environment needed to deliver those returns safely, consistently, and responsibly.
Excellent, Judy. Thank you so much.
All right.
And I'm sure
Thank you,
we'll
Leon.
talk again. All the best.
All right. Take care. Have a good day. Bye-bye.